Welcome to the Deep Dive. Today, we're embarking on a mission crucial to your success, preparing you to truly excel on the SAFE exam.
hmm
Think of us as your personal NMLS trainers, really cutting through the noise and delivering the precise, actionable knowledge you need. Well, to secure that flawless score, every detail we unpack today is designed to put you in that top percentile.
That's precisely our aim. Our
Mhm.
goal today is to equip you with the technical knowledge, the intricate details, and
Now,
the critical insights required for a perfect score on the SAFE exam.
right.
We're not just reviewing, we're meticulously dissecting four foundational mortgage acts, emphasizing every fact, every figure, and every precise condition you need to internalize.
Okay.
We're focusing on those nuances that distinguish, a strong understanding from absolute mastery.
And to achieve that mastery, we'll be systematically unpacking the Homeowners Protection Act, the SAFE Act, the Home Mortgage Disclosure Act, and the Dodd-Frank Act.
That's the plan.
These aren't just legal documents. They are really the cornerstones of responsible mortgage lending in the U.S. Understanding their intricacies isn't just about passing an exam. It's about becoming a truly informed and effective mortgage loan originator.
Absolutely. Foundational knowledge.
So let's start our deep dive into the Homeowners Protection Act, or HPA. What's its primary purpose and why was it enacted? What problem was it really trying to solve, in the mortgage landscape that led to its creation?
Okay, yeah. For your exam, you really need to grasp the fundamental why behind the HPA. Its main goal is to facilitate the cancellation of private mortgage insurance, or PMI, on residential mortgage transactions.
Okay, PMI cancellation.
Right. Before the HPA was enacted back in 1998, the process for canceling PMI was often, was opaque, confusing, and really inconsistent across different lenders.
Mm-hmm.
Homeowners could end up paying for PMI for years longer than was fair or necessary, even after building substantial equity in their homes. It was a common pain point for borrowers.
I can imagine.
So the HPA stepped in to establish uniform, clear procedures. It protects homeowners from this sort of open-ended burden by setting specific rules and timelines for when PMI must be canceled or can be canceled. In essence, it's about empowering the borrower. It gives them clear rights and establishes enforceable boundaries for lenders and servicers, ensuring that once a certain equity threshold is met, they aren't stuck paying an unnecessary insurance premium. This consumer protection aspect is core to the HPA's purpose. You must remember that connection.
That makes perfect sense. It sounds like it was a critical step to bring transparency and fairness to a process that was, frankly, ripe for exploitation, maybe.
That's a fair assessment.
So when we talk about who this act applies to, who exactly is covered by HPA, and just as important for that top score who's explicitly exempt, knowing the scope and exclusions can be a major differentiator on exam questions.
That's an insightful way to frame it, and yes, absolutely crucial for the exam. The HPA applies to conventional residential mortgage transactions that were consummated on or after July 29, 1999.
Okay, that date, July 29, 1999.
Correct. Write that down. It specifically covers loans secured by the borrower's principal residence and used for its purchase, construction, or refinance.
Principal residence, got it.
So we're talking about single-family homes that are lived in by the borrower, not investment properties or commercial ventures. And it governs the actions of lenders, servicers, and even the PMI insurers themselves.
Okay.
Now, for that absolute clarity required for your exam, you must internalize the exemptions, because these are frequently tested distinctions that can easily trip you up.
Okay, exemptions. Lay them out.
The Act does not apply to government-insured loans. This means FHA or VA loans are explicitly excluded from HPA's provisions.
FHA-VA out. Why is that?
Well, the rationale here is that these government-backed programs have their own distinct mortgage insurance or funding fee structures and cancellation rules, right? So HPA avoids overlapping with those specific government programs. You won't be applying HPA cancellation rules to an FHA or VA loan. Memorize that.
Makes sense. Avoids confusion. What else?
And crucially, it also does not apply to loans where the lender pays for the private mortgage insurance, known as lender-paid PMI or LPMI.
Ah, LPMI, right.
If the lender is covering the premium, the borrower isn't directly paying it, so the HPA's protections against burdensome ongoing premiums, well, they just don't apply in the same way. These two categories, government-insured and lender-paid PMI, are vital exclusions to commit to memory.
Okay, so repeat that. Conventional, borrower-paid PMI, primary residence. That's the focus.
Exactly. Government or lender-paid are excluded. Nail that down.
That really clarifies the playing field. So it's about conventional borrower-paid PMI on your primary residence. Government or lender-paid loans are simply out of scope. That's a crucial filter for exam questions and real-world scenarios.
Correct.
Now let's get into the mechanics. This is where it gets truly fascinating and where precision can make or break your score. How does PMI actually get canceled or terminated under HPA? What are the specific rules, the percentages, and the exact conditions for each pathway? This sounds like high-yield territory.
You're absolutely right. This is prime exam material. The HPA provides 3 distinct and critical pathways for PMI to be removed, and you need to know these thresholds and their precise conditions cold. Let's break them down. Pay close attention to the subtle differences.
Okay, pathway 1.
First, we have borrower-initiated cancellation. This occurs when a borrower actively requests it. A borrower may submit a written request to their servicer to cancel PMI.
Written request, key action.
Very key. This is permissible when the principal balance of the loan is scheduled to reach 80% of the home's original value.
80% LTV.
Schedule.
Okay, and original value, how's that defined?
Good question. The term original value is precisely defined for the exam. It's the lesser of the sales price or the appraised value at consummation of the loan.
Lesser of sale price or appraisal, got it.
So if a home sold for $300,000, but appraised for $290,000 at closing, the original value for HPA purposes would be $290,000. It's a small but important detail. Memorize that definition. Lesser of.
Okay, so they hit 80% LTV based on that original value, send a written request.
Wow.
What else?
The cancellation is strictly contingent on 3 conditions that you must recall accurately. 1, the borrower must have a good payment history. What does that mean? Typically, no payments 60 days or more past due in the last 12 months, and no payments 30 days or more past due in the past 24 months.
Good payment history, check.
2, they must be current on payments at the time of the request. Not just historically good, but current now.
Current, okay.
And finally, number 3, they must certify that they do not have any subordinate liens on the property.
Certify no subordinate liens. Can you clarify what exactly a subordinate lien means in this context? That term might be new for some listeners.
Excellent question, yes. When we say subordinate liens, we're referring to any other loans or claims secured by the property that would come after the primary mortgage in terms of repayment priority if the home were sold or foreclosed.
Okay, like a second mortgage.
Exactly. Think of a second mortgage, a home equity line of credit, HELOC, maybe even certain types of property tax liens like a PACE lien in some areas. If you have an HELOC, that's a subordinate lien. The presence of such liens can complicate the lender's risk profile, which is why it's a specific condition for the borrower-initiated cancellation at 80%. It ensures the primary lender's position isn't overly diluted by other claims. Make sure you understand what counts.
That makes perfect sense. It affects the risk calculation, so that no subordinate liens point is definitely one to underscore.
Okay, so that's the 80% borrower-initiated path. What's the next pathway?
Exactly. Moving on to the second pathway, which importantly requires no borrower action, automatic termination.
Automatic. Okay, easier for the borrower.
In theory, yes. PMI must be automatically terminated by the servicer on what's called the termination date. This date is when the principal balance is scheduled to reach 78% of the original value, based on the initial amortization schedule.
78%.
Okay.
A bit lower LTV than the request path, and based on the original schedule.
Correct. The key here is schedule to reach. It's based on the original loan schedule, not necessarily accelerated payments, though prepayments can sometimes move the date up. But the trigger is that scheduled 78% mark. Got it. And conditions for this one still need good payment history and no liens.
This is a critical differentiator you need to memorize. For automatic termination at 78%, the only condition is that the borrower must be current on their loan payments on the actual termination date.
Only current, that's it.
That is it. There's no requirement for a specific good payment history over the past year or two, and no certification about subordinate liens is needed for this automatic path. Just being current when that 78% LTV mark is hit on the schedule.
Wow.
This rule ensures that even if a borrower isn't proactive, or maybe forgets, the PMI will eventually come off as long as they're not behind on their payments when the date arrives.
So no borrower action needed at 78% LTV, as long as they're current. This is a significant distinction from the 80% rule, where the borrower has to be proactive with a written request and meet those extra conditions.
Exactly.
That 2% difference between 80% and 78% and the different conditions definitely sounds like a common trap for test takers, isn't it? Seems small, but is functionally huge.
It absolutely is a common trap, and you must nail that distinction for your exam. 80% is borrower request with conditions, 78% is automatic if current. Burn that into your memory.
Okay, 80% request, 78% automatic. Got it. What's the third pathway?
The third pathway is final termination, sometimes called midpoint termination, if PMI has not been otherwise canceled or terminated by either of the previous methods.
Meaning the 80% request didn't happen or qualify, and the 78% automatic date passed perhaps because they weren't current.
Exactly. If it hasn't stopped by then, it must terminate when the borrower reaches the midpoint of the loan's amortization period.
Midpoint. So like year 15 on a 30-year loan.
Precisely. For a standard 30-year loan, that would be after 15 years, regardless of the loan-to-value ratio at that point. Even if property values dropped or they never made extra payments, it terminates.
Interesting. A final backstop.
It is. This provision acts as a final backstop, ensuring PMI doesn't just linger indefinitely, even if property values haven't appreciated or the borrower hasn't made extra payments. It's a definitive end to PMI for compliant borrowers.
And the condition for this final midpoint termination?
Again, consistent with automatic termination, the crucial condition is simply that the borrower must be current on payments when that midpoint date arrives.
Just current again.
So
Right.
even if the 80% or 78% marks are somehow missed or values shift, HPA provides a final fail-safe at the loan's midpoint, ensuring PMI eventually comes off provided they're current. It really closes potential loopholes.
That's a really comprehensive safety net for the borrower. It truly closes all potential loopholes for continuous PMI payments.
To truly excel in your exam, let me reiterate. You must internalize these three thresholds: 80% for borrower request, 78% for automatic termination, and the midpoint for final termination.
80, 78, midpoint.
And more importantly, you need to understand the subtle but critical differences in conditions for each. The good payment history and no subordinate liens are specific to the 80% borrower-initiated request, while only needing to be current on payments is required for the 78% automatic and midpoint final terminations. That level of granular detail is precisely what separates a good score from a perfect one. Know the conditions for each path.
Got it. Conditions are key.
Now, a small but important note that sometimes appears in questions. HPA does mention an exception for loans defined as high risk.
High-risk loans. What does that mean in this context?
Good question. These loans follow different termination rules than the standard ones we just covered. When we say high risk, we're typically referring to loans with very high initial loan-to-value ratios, sometimes 90% or 95% plus LTV, or those with certain non-traditional payment structures that inherently carry more risk for the lender and insurer.
Okay.
Because of this elevated risk, the standard 80%, 78% midpoint rules for PMI termination might not apply, or the timelines could be extended under specific guidelines set by Fannie Mae or Freddie Mac, for example. This ensures the lender and insurer are adequately protected during the loan's riskiest initial period.
So it's about balancing protection with risk.
Exactly. Be aware this exception exists, even if you don't need to memorize every single high-risk scenario permutation for the SAFE exam. Just know the standard rules can be modified for high-risk loans.
Okay, noted. Beyond the cancellation rules, what specific disclosures are lenders and servicers required to provide under HPA? These seem vital for compliance and ensuring the borrower knows their rights, which of course makes them vital for the exam.
Indeed. Disclosures are always heavily tested. For fixed-rate loans requiring PMI, the lender has crucial disclosure obligations right at closing.
At closing, what do they have to provide?
They must provide the borrower with an initial amortization schedule. This is important because it's the schedule from which the automatic termination date, that 70% LTV point, is calculated.
Makes sense. They need the schedule to know the date.
Precisely. Additionally, they must provide clear written notices specifically regarding the borrower's right to request cancellation at 80% LTV and the precise date of automatic termination at 78% LTV.
So telling them about both the request option and the automatic date at upfront.
Yes. These aren't just general statements. They're specific notifications required by HPA that truly empower the borrower by giving them a roadmap right from the start. You need to know these initial closing disclosures.
Okay. What about after closing?
Loan servicers also have ongoing obligations under HPA. They must provide an annual notice to the borrower.
Annually. What's in that?
It reminds them of their right to cancel or terminate their PMI. This ensures the borrower doesn't forget these rights over the years, especially if they're not tracking their loan balance closely.
A yearly reminder. Good practice.
And finally, and this is another frequently tested timeline, a final notice must be sent to the borrower within 30 days of the actual cancellation or termination of PMI.
Within 30 days of it actually stopping.
Correct. This notice confirms the PMI has officially been removed and the borrower is no longer paying the premium. These specific timings, at closing, annually, and then within 30 days of cancellation, are all very testable, so commit them to memory.
So disclosures at closing, annually, and then a final confirmation within 30 days of the actual cancellation. That's a very clear compliance roadmap that the exam will expect you to know inside and out. It paints a picture of constant transparency.
Exactly. Transparency is a key goal. Now let's nail down those specific timelines and penalties again, just to isolate them, as they are often separate, specific questions on the exam designed to test your precision.
Okay, let's bullet point these.
For your exam, remember the PMI cancellation notice. We just said it, but commit it. A notice must be provided to the borrower within 30 days of the cancellation date.
30 days. Got it.
The statute of limitations for bringing a legal action for an HPA violation is 2 years.
2 years.
That's 2 years from the date the violation was discovered.
Yeah.
Not necessarily when it happened, but when the borrower reasonably found out about it.
Okay, 2 years from discovery. Important distinction.
Very important. And finally, penalties. Statutory damages for individual actions for HPA violations are capped at $2,000.
$2,000 cap for individual damages.
Correct. This is the maximum a court can award in statutory damages to an individual for a violation under this specific act. There might be other damages, but the statutory cap is $2,000. Memorize that number.
30 days for the cancellation notice, 2 years for the statute of limitations from discovery, and a $2,000 cap on statutory damages for individual actions. Commit these precise figures to memory. They are prime targets for specific recall questions.
You got it. Those are the key HPA numbers.
Okay, so HPA protects the homeowner's wallet from unnecessary insurance. But what about protecting the homeowner from problematic loan originators themselves? That sounds like where the SAFE Act fundamentally steps in, right? Professionalizing the very people you, the listener, are aiming to become. This one feels absolutely central to being an MLO. It's literally in the name of the exam.
You're exactly right. The SAFE Act, which stands for the Secure and Fair Enforcement for Mortgage Licensing Act, was passed in 2008. It was Title V of the Housing and Economic Recovery Act, or HRA.
Title V, okay.
And yes, prior to the SAFE Act, the mortgage industry was, in many ways, you could call it a Wild West. Licensing standards varied wildly from state to state, or sometimes didn't exist at all for certain types of originators.
Inconsistent.
Very. This lack of uniformity contributed to a climate where fraud and predatory lending could more easily proliferate, which, as we know, led directly to the housing crisis of 2008.
Right. A major contributing factor.
Absolutely. So the SAFE Act was specifically designed to regulate the mortgage industry by establishing minimum national standards for the licensing and registration of mortgage loan originators, or MLOs.
Minimum national standards. Key
Yeah.
concept.
Critical concept. Its core purpose is to enhance consumer protection and reduce fraud in the mortgage market by ensuring that anyone originating a loan is qualified, accountable, and held to clear, consistent standards.
Yeah.
And perhaps its single most significant impact, which is paramount for your exam, is that it is the act that established the Nationwide Multi-State Licensing System, or NMLS.
NMLS. Everyone studying knows that acronym.
They better. The NMLS is the centralized system used for MLOs to be either state licensed or federally registered, creating a unified database and a more consistent regulatory environment across state lines. You must know, SAFE created NMLS.
That centralization and standardization must have been a game changer. It sounds like it brought much needed order. But okay, you mentioned state licensed versus federally registered. What's the difference between them, and how do regulations G and H fit in? This seems like a fundamental concept for any MLO, and certainly for the exam. It defines your regulatory pathway, right?
Yeah, this is a critical distinction for the exam, one you must know with absolute precision, as it defines your regulatory oversight and which rules apply to you. You need to know these definitions cold.
Okay, let's start with Reg G.
Regulation G applies specifically to MLOs who are employees of depository institutions.
Depository institutions, like banks.
Exactly.
Yeah.
When we say depository institutions, we're talking about federally insured entities like banks, savings associations, and credit unions. Think FDIC or NCUA insured.
Yeah.
Because these institutions are already heavily regulated at the federal level by agencies like the FDIC, OCC, Fed, or NCUA, Their MLOs are required to be federally registered with the NMLS.
Federally registered, not licensed.
Correct. They fall under federal oversight and don't obtain individual state licenses. Instead, they are registered under their federal employer's umbrella via the NMLS. So Reg G, Depository Institution, federally registered MLO. Memorize that link.
Okay. Reg G, Depository Federal Registration. What about Reg H?
In contrast, Regulation H applies to MLOs who are employees of non-depository institutions.
Non-depository, like mortgage companies.
Yes, entities like state-licensed mortgage lenders, mortgage brokers, or independent mortgage companies that don't take deposits. Since these institutions are typically regulated primarily at the state level, their MLOs must be state-licensed and registered with the NMLS. This is where the majority of mortgage loan originators fall if they're not working directly for a bank or credit union.
So they need a license from each state they operate in.
Generally, yes, unless there are specific reciprocity agreements. But the key is state-level licensure plus registration on NMLS. This distinction allows states to maintain their regulatory authority over these non-depository entities while still leveraging the NMLS for consistent background checks, testing, education tracking, and enforcement actions. So, Reg H, non-depository institution, state-licensed MLO.
Depository equals Reg G and federally registered. Non-depository equals Reg H and state-licensed. Make sure you can differentiate these quickly and accurately on the exam because they will test that foundational knowledge, often with scenario-based questions asking which applies.
Absolutely. That distinction is fundamental.
Now for the absolute nitty-gritty. What does it take to get and keep that state license under Reg H? This is where your diligent study of specific numbers and conditions will pay off big time for your exam. Every single one of these points feels like high-yield material.
You are absolutely right. Pay very close attention to these specific numbers and conditions. These are prime targets for detailed questions designed to test your recall and understanding. Let's break down the minimum licensing requirements.
Okay, first step.
First, on background checks and felony rules. All applicants must undergo a criminal history background check through the NMLS, which includes fingerprinting.
Standard procedure.
Yes. Now, the key rules. A license will not be granted if the applicant has had a felony conviction during the 7-year period preceding the application date.
7-year look back for any felony.
For most felonies, yes. But here's where it gets even more critical, and this is a key point you must commit to memory for that perfect score. A felony conviction at any time, meaning no look-back period, it's a lifetime ban, will prohibit licensure if it involved an act of fraud, dishonesty, a breach of trust, or money laundering.
Wow, okay, so fraud, dishonesty, breach of trust, money laundering, those are lifetime disqualifiers, regardless of when they happened.
Correct. That at any time clause for these specific types of financial integrity felonies is vital and often a test point because there's no time limit. It underscores the industry's absolute zero-tolerance policy for these kinds of offenses. Memorize those 4 specific types of felonies.
Fraud, dishonesty, breach of trust, money laundering, got it. Anything else on background?
Yes. Also, an applicant must not have had a loan originator license revoked previously in any governmental jurisdiction. If it was revoked in the past, no new license will be granted. It's generally a permanent disqualifier.
So 7 years for general felonies, but a lifetime ban for those specific financial felonies and for any prior license revocation. That's a pretty stark difference, and it really underscores how seriously the industry views integrity, doesn't it? Don't mix those up. That at any time distinction is huge.
Absolutely. Nail those felony rules down. Next, let's talk about pre-licensing education. PE.
PE hours, always a big topic.
It is. An applicant must complete at least 20 hours of NMLS-approved pre-licensing education. This is the minimum total.
20 hours minimum.
But the specific breakdown of those hours is what you must memorize for your exam because it's frequently tested. Within those 20 hours, there must be 3 hours of federal law and regulations.
3 federal law.
3 hours of ethics covering consumer protection, fraud prevention, fair lending, and ethical conduct.
3 ethics, very important.
And 2 hours of training on non-traditional mortgage products.
2 non-traditional, like adjustable rate mortgages, interest only, that kind of thing.
Exactly. Products that became critical to understand after the crisis revealed their inherent risks if not handled properly.
Okay, so that's 3 plus 2 equals 8 required topic hours. What about the other 12?
The remaining 12 hours can be on other relevant mortgage origination topics, often called electives, as approved by the NMLS. But you must know that specific 332 breakdown for federal law, ethics, and non-traditional products within the 20 total hours. Very testable.
20 hours total with that precise 332 breakdown for federal law, ethics, and non-traditional products. Got it marked down. This is definitely exam fodder.
Moving to testing requirements and retake rules. An applicant must pass the national test component with uniform state content, the SAFE MLO test, with a score of 75% or better.
75%, that's the magic number to pass.
Correct. Now, the retake waiting periods are critical for your exam and are very frequently tested. Don't just know the passing score, know these rules.
Okay, retake rules. What are they?
If an applicant fails the exam, they must wait at least 30 days before retaking it.
30 days after the first fail, or any fail?
After any fail initially, so fail once, wait 30 days, fail twice, wait another 30 days. But then,
there's a catch.
after failing 3 consecutive times, an applicant must wait at least 6 months before retesting.
6 months after the third straight fail. Ouch.
Yes. This longer period is designed to ensure a more comprehensive review and a deeper re-engagement with the material before another attempt. It emphasizes that the test isn't just about rote memorization, but true comprehension, and prevents people from just repeatedly taking it, hoping to get lucky.
So don't just know the 75% passing score. Know those retake rules inside and out. 30 days between attempts 1, 2, and 3, and then a 6-month wait after the third consecutive failure. Those specific timeframes are definitely hot spots for exam questions, so mark them well.
Absolutely. Memorize 30 days and 6 months after 3 fails.
Got it. So pass the test, meet the background and PE requirements.
Yeah.
Then you get the license. How do you keep it?
Good question. To maintain that license once you have it, there's continuing education, CE.
The annual requirement.
Exactly. To maintain a license, an MLO must complete a minimum of 8 hours of NMLS-approved continuing education each year.
8 hours annually, minimum.
Correct. This is an annual requirement designed to keep MLOs current with changing laws, market practices, and ethical standards. And just like pre-licensing, there's a specific breakdown you need to know for your exam. Within those 8 hours, the required topics are 3 hours of federal law and regulations.
3 federal law again.
2 hours of ethics. Note that's 2 hours for CE versus 3 for PE.
Good catch. 2 ethics for CE.
And 2 hours of training on non-traditional mortgage products. Again, 2 hours, same as PE.
2 non-traditional. Okay, so that's 3 plus 2 plus 2 plus 2 required hours.
Right. The remaining 1 hour can be an elective on other relevant mortgage topics.
So 8 hours annually with its own specific breakdown. 3 federal, 2 ethics, 2 non-traditional, 1 elective. It's interesting to notice the difference in ethics hours compared to PE. Those small differences are often what's tested. They want to see if you can differentiate between the initial education and the ongoing requirements.
That's a perceptive observation, and it's precisely the kind of detail that will boost your score. You must know the CE breakdown, 3, 2, 2, plus 1 elective for a total of 8 hours annually, differentiated from the 20-hour PE breakdown, 3, 3, 2, plus 12 electives.
Got it. PE is 20, 3 SED, 3 ethics, 2 non-trad. CE is 8 annually, 3 fed, 2 ethics, 2 non-trad. Memorized.
Excellent. Finally, for license maintenance, there's one more small but crucial detail that often trips people up. The 5-year rule.
The 5-year rule? What's that?
An individual who takes and passes the licensing exam, but then fails to maintain a valid state license, meaning they let it lapse or become inactive for a period of 5 years or longer, must retake the exam.
Retake the entire SAFE exam, not just do more CE.
Retake the exam. This isn't just about catching up on CE, it's about redemonstrating foundational knowledge, because the NMLS presumes the knowledge has lapsed and become outdated over such a long period of inactivity in the licensed role.
Wow. 5 years out, you start over with testing.
Essentially, yes.
Okay.
And here's a nuance. This 5-year period does not take into account any time spent working solely as a registered mortgage loan originator under Reg G.
Meaning working at a bank doesn't stop the clock for your state license requirement.
Correct. If you were state licensed, then went to work at a bank as a federally registered MLO for, say, 4 years, and then left the industry entirely for 1 more year. That state license has been inactive for 5 years. If you want to become state licensed again, you'd likely need to retake the test, even though you were registered during part of that time. The clock applies to maintaining an active state license.
So 5 years out of the state licensed game, you're back to square one with the exam. That's a key retention rule and a serious consequence for getting your license lapsed for too long. It emphasizes that this isn't a set it and forget it profession.
Precisely. It requires continuous engagement or facing retesting. Remember that 5-year timeline for license reinstatement via testing.
5 years. Got it. Lastly, for SAFE.
Yes, penalties for noncompliance.
Yeah.
The maximum civil penalty a state licensing agency may impose for each act or omission in violation of the SAFE Act is $25,000.
$25,000 per violation.
Per each act or omission. This is a substantial penalty. To give you context, this means if an MLO violates the act multiple times or in multiple ways within a single transaction or across several transactions, those penalties can stack up very rapidly. It's not a blanket fine, it's per incident.
That could get very expensive very quickly.
It certainly could. This really underscores the importance of meticulous compliance with all the SAFE Act's requirements. From licensing to education to testing to ethical conduct. It acts as a very strong deterrent against negligence or misconduct. You must know that $25,000 maximum penalty per violation number.
A substantial penalty, emphasizing the importance of meticulous compliance for every single act or omission. It's a clear message about accountability in the industry. Okay, $25K per violation. Committed to memory.
Good. That covers the core SAFE Act requirements you need for the exam.
So, SAFE Act brought order and raised the bar for individual MLOs. Now let's move from regulating the people to regulating the data collected on mortgages, which has massive implications for fairness and equity. Moving on to HMDA, the Home Mortgage Disclosure Act, also known as Regulation C.
Regulation C. Correct.
What's the big picture here? Why collect all this data? It feels like a lot of paperwork for lenders, but there must be a compelling reason, right?
There absolutely is. HMDA is fundamentally a data collection and reporting law. It requires institutions to collect and report a vast amount of information about mortgage applications and the resulting loans. For your exam, you need to know its three primary purposes. You can think of them as the pillars of HMDA. These are absolutely key for understanding the Act's intent and how the data is used.
Okay, the three pillars of HMDA. What's pillar number one?
First, the data helps to determine if depository institutions are meeting the housing needs of their communities. Particularly, are they meeting the credit needs of the neighborhoods where they operate?
So are banks lending where they take deposits, essentially?
That's part of it, yes. Before HMDA, it was difficult to tell if banks were truly serving all segments of their local population. Now the data provides transparency, revealing where lending is occurring and, crucially, where it might be lacking, potentially indicating unmet needs or avoidance. This allows regulators and community groups to assess performance.
Okay, community needs assessment, pillar two.
Second, and critically important, it's used to identify potentially discriminatory lending practices and patterns, such as redlining.
Redlining, that's a huge focus.
It is. Think of it. Before HMDA, a lender could potentially avoid lending in certain neighborhoods, perhaps based on demographics, perpetuating economic disparities. HMDA data, by making loan application details, including applicant demographics and location, and approval denial rates transparent, forces accountability. It's a powerful tool for regulators and fair housing advocates to spot potential redlining, the illegal practice of denying services to residents of certain areas based on race or ethnicity. This isn't just theory. It's about ensuring fair access to homeownership for all communities. You must know HMDA's role in identifying discrimination.
Fighting discrimination. Vital, pillar three.
And third, the data helps government officials determine how to distribute public sector investments.
Public investment. How so?
Governments and housing agencies use this HMDA information to decide where to allocate resources for housing and community development programs. If HMDA data shows a consistent lack of private lending in certain underserved areas, public funds can be strategically directed to those communities to stimulate growth, support affordable housing initiatives, and address housing disparities identified through the data. It's about targeted public investment based on real, granular data.
So pillar one, community needs. Pillar two, identifying discrimination like redlining. Pillar three, guiding public investment. All driven by data transparency. It makes perfect sense why collecting this information is so vital, even if it feels burdensome for lenders. It's about creating a more equitable playing field.
Precisely. Those three purposes are core HMDA knowledge for your exam.
Okay, so who does HMDA apply to? Are there specific thresholds that trigger these reporting obligations? Because this isn't for every single lender out there, correct?
That's right, not everyone reports. There are crucial thresholds you need to know for the exam, as these determine who is a covered institution required to collect and report HMDA data.
Thresholds, okay.
HMDA applies to both depository institutions, banks, credit unions, and non-depository institutions, mortgage companies, that have a home or branch office in a metropolitan statistical area, MSA. But the key for coverage hinges on these specific thresholds, which are designed to capture institutions with significant mortgage activity.
What are the thresholds?
Okay, there are two main types. First, there's the asset size threshold, which applies only to depository institutions.
Only banks and credit unions for this one.
Correct. This threshold is annually adjusted by the CSPB based on the Consumer Price Index, so the exact dollar amount changes each year. You should know the concept and be aware it exists, but memorizing the exact figure for the current year might be less critical than understanding the loan volume threshold, which is more stable. For context, though, for data collected in 2025, institutions with assets below a certain level, e.g. $58 million as of December 31, 2024, but always check the current figure, are exempt.
Okay, so small depositories might be exempt based on assets. What's the other threshold?
Second, and this is highly testable because it applies more broadly, is the loan volume threshold. This is a uniform threshold that applies to both depository and non-depository institutions.
Applies to everyone. What's the volume needed?
An institution is covered if it originated at least 25 closed-end mortgage loans in each of the 2 preceding calendar years,
25 closed-end loans.
or at least 200 open-end lines of credit, like HELOCs, in each of the 2 preceding calendar years.
Okay, so either 25 closed-end or 200 open-end.
Correct, and that in each of the 2 preceding calendar years, clause is absolutely critical. It's not just one busy year that triggers it. It's a consistent volume over a 2-year period that indicates a significant enough presence in the mortgage market to warrant reporting.
So if they did 30 closed-end loans last year, but only 10 the year before, they're not covered yet based on closed-end.
Exactly. They need to meet the threshold in both of the 2 preceding years. This ensures that only consistently active lenders are subject to the reporting requirements. You must memorize these loan volume thresholds. 25 closed-end or 200 open-end, each of the 2 preceding years requirement.
Okay, so an asset size threshold just for depositories, but a loan volume threshold, 25 closed-end or 200 open-end, in each of the last 2 years. That applies to everyone. And critically, that each of the 2 preceding calendar years clause for loan volume, that consistency element is key for the exam.
Precisely. Know those thresholds cold.
Right. So if an institution is covered, what specific data is collected and how is it reported? This section often raises questions, especially about sensitive demographic information, right? And it's definitely exam territory.
Yes, absolutely. Covered institutions must collect data for each application received in each loan originated or purchased and report it annually on a loan application register, or LAR.
The LAR. Okay, that's the official report.
Correct. The LAR is essentially a comprehensive spreadsheet, the official record that HMDA requires. It details various aspects of each loan application or origination, including things like loan type, loan purpose, property type, property location, census tract, loan amount, pricing information, underwriting factors, and crucial borrower demographic information.
Demographic info. This is the sensitive part, right?
It is. A critical aspect of HMDA for the SAFE exam is the collection of demographic data, specifically applicant ethnicity, race, and sex.
But doesn't EQOA usually prohibit asking for that?
Excellent point, and a crucial distinction to understand for the exam. Yes, the Equal Credit Opportunity Act, EQOA, or Regulation B, generally prohibits creditors from asking for information about race, color, religion, national origin, or sex to prevent discrimination in the credit decision.
So how can HMDA require it?
HMDA provides a specific exception to EQOA's general prohibition for the express purpose of monitoring compliance with fair lending laws. So EK says don't ask to make a credit decision, but HMDA requires you to ask for monitoring purposes. You collect it, report it under HMDA, but you cannot use it to decide whether or not to grant the loan. This is a key point. HMDA mandates collecting this data precisely to help identify and combat the discrimination that EQOA prohibits. It's a critical tool for civil rights enforcement.
Okay, so HMDA says don't use it for the decision. HMDA says you must collect it for monitoring. That's a vital distinction.
Absolutely vital. Know that HMDA requires collecting ethnicity, race, and sex, even though EQA generally restricts asking about it.
Now, what about how you collect it? What if the applicant doesn't want to provide it?
Another excellent question leading to a must-know, frequently tested detail, the visual observation rule.
Visual observation, what's that?
If an application is taken in person, meaning face-to-face, and the applicant chooses not to provide information on their ethnicity, race, and sex on the application form.
They check the I do not wish to provide box.
Exactly. If they do that in a face-to-face meeting, the originator must first note that fact on the collection form indicate the applicant declined, and then the originator must record the data based on their visual observation and surname.
So the MLO has DES based on how they look and their last name.
Essentially, yes, but it's a requirement. For example, if an applicant checks prefer not to say in a face-to-face meeting, but their surname is typically associated with a certain ethnicity, and you observe their appearance, you would still record the ethnic and racial data based on that observation and surname for HMDA reporting.
Wow, that feels a little awkward.
It can be, but it's the rule. This ensures the demographic data is still collected for HMDA's monitoring purposes, even when the applicant declines to self-identify in person. Importantly, this visual observation rule only applies when the application is taken face-to-face. You cannot visually observe an application taken by mail, internet, or phone. In those cases, if the applicant declines, you report that they declined.
Okay, so the visual observation rule is only for face-to-face applications where the applicant declines to self-identify. That's a very specific, actionable detail for an MLO and precisely the kind of practical knowledge that gets tested. It shows how committed the law is to collecting this data.
Correct. Commit to that rule and its face-to-face limitation to memory.
And reporting timelines. When is the LAR due?
Covered institutions must submit their LAR data to the CFPB annually, typically by March 1st of the year following the calendar year for which the data was collected. So data for 2024 would be reported by March 1st, 2025.
March 1st annually. Got it.
And just to tie this back to the threshold again, remember that an institution's requirement to report HMDA data is based on its loan origination volume in either of the two preceding calendar years, meeting those 25 closed-end or 200 open-end thresholds. This connects directly back to those thresholds we covered, reiterating that it's about recent, consistent activity.
Consistent activity triggers the reporting. Makes sense. Okay, that covers HMDA and its focus on data for transparency and fairness. So we've covered HPA for PMI, SAFE for MLO standards, HMDA for data. Now let's turn to the grand architect behind much of modern mortgage regulation. Finally, the Dodd-Frank Act. This feels like the comprehensive response to the crisis, a truly seismic shift, doesn't it? The big one.
It absolutely is. The Dodd-Frank Wall Street Reform and Consumer Protection Act, it's a mouthful, was signed into law in July 2010. It was a direct and massive legislative response to the financial crisis of 2008.
Right, the meltdown.
Exactly. Before Dodd-Frank, the financial system, particularly the mortgage market, was, as we've touched on, riddled with practices that contributed to the crisis. Things like irresponsible lending, subprime lending without verifying ability to repay, opaque financial products like complex mortgage-backed securities, and a fragmented regulatory landscape where different agencies had overlapping or sometimes conflicting responsibilities, and consumer protection often fell through the cracks.
Yeah, recipe for disaster.
It proved to be. So the Dodd-Frank Act's aim was sweeping reforms across the entire financial industry, but with a substantial impact on mortgage lending specifically. The overarching goals were increasing consumer protection, promoting financial stability by addressing too-big-to-fail institutions, and reducing systemic risk, essentially trying to make sure a crisis of that magnitude wouldn't happen again. It truly reshaped the regulatory landscape from the ground up.
That sounds incredibly ambitious. What's its single most significant legacy for the mortgage industry? The one thing we absolutely need to hammer home for the exam. This seems paramount.
Undeniably, its most significant effect on the mortgage industry that you must know for the exam was the establishment of the Consumer Financial Protection Bureau, or CFPB.
The CFPB, created by Dodd-Frank.
Correct. The CFPB is an independent federal agency housed within the Federal Reserve, but operating independently. It was given broad authority to regulate consumer financial products and services, including, very prominently, mortgages.
So it took over from other agencies.
Yes. Before the CFPB, consumer protection oversight for mortgages was scattered across multiple federal agencies, the Fed, HUD, FTC, banking regulators. It was confusing. Dodd-Frank consolidated much of this authority. The CFPB effectively took over rulemaking, enforcement, and supervisory authority for most of the major federal mortgage laws we discuss, like TILA, RESPA, ECOA, HMDA, and others. It became the primary watchdog for consumer finance in the mortgage space. Knowing the CFPB's role, its broad powers, and its origin in Dodd-Frank is absolutely critical for your exam.
So CFPB centralizing regulation, rulemaking, enforcement, overseeing consumer financial protection born directly from Dodd-Frank. That's a key connection you absolutely have to know. It's the new sheriff in town put there by Dodd-Frank, and it has real teeth.
Exactly. Think Dodd-Frank.CFPB major mortgage rules.
Okay. And Dodd-Frank didn't just create the CFPB. You mentioned it mandated the creation of several new critical rules that the CFPB then implemented. Which ones are absolutely essential for us to understand for the exam? These sound like the practical application of Dodd-Frank's principles.
Yes. Dodd-Frank directed the CFPB, or other agencies initially, with authority transferring to CFPB, to create several critical mortgage regulations that are absolutely foundational to the safe exam. You need to understand the purpose and key function of each of these major rules that stemmed from Dodd-Frank mandates.
Okay, let's break them down. Rule number one.
First, and perhaps most fundamentally impacting underwriting, there's the ability to repay, ATR, qualified mortgage, QM rule.
ATRQM, heard a lot about that.
As you should. This rule, implemented primarily under TILA, Regulation Z, mandated that creditors must make a reasonable, good faith determination of a borrower's ability to repay any residential mortgage loan before making the loan.
Ability to repay. Sounds basic, but wasn't always required.
Shockingly, no, not explicitly and universally like this. During the run-up to the crisis, stated income loans, no-doc loans, or liar's loans were common, where lenders didn't adequately verify income or assets, leading to borrowers getting loans they couldn't possibly afford long-term. The ATR rule put an end to that, requiring verification of income, assets, debt obligations, credit history, and more, pushing for genuinely responsible lending practices based on documented ability to pay.
So verify, verify, verify.
Essentially, yes. Document the borrower's ability to handle the payments. Now, tied to ATR is the concept of the qualified mortgage, or QM.
QM, what's that?
The rule also established the definition of a qualified mortgage. A QM is a specific category of loan that is presumed to comply with the ATR rule. Making a QM loan provides the lender with certain legal protections, either a safe harbor or a rebuttable presumption, meaning it's harder for a borrower to later claim the lender violated the ATR rule.
So lenders want to make QM loans for the legal protection.
Absolutely. Lenders strongly prefer to make QMs because of this legal protection. To be a QM, a loan must meet specific criteria, such as having regular payments that don't result in negative amortization, generally avoiding risky features like interest-only periods or balloon payments, with some exceptions for small creditors, limiting points and fees charged to the borrower, and meeting certain underwriting requirements related to debt-to-income ratios or pricing thresholds. Understanding the basic concept of ATR must verify ability to repay, and QM, a loan with specific features presumed to meet ATR, is essential.
Can they afford the loan? That's the core question ATRQM addresses, pushing for responsible lending and protecting both the borrower and the lender from making unsustainable loans. It really changed the risk profile of lending. You must know ATRQM came from Dodd-Frank.
Correct. Memorize that link. Next major rule mandated by Dodd-Frank.
Okay.
The loan originator LO compensation rule.
LO comp. Affects MLOs directly.
Very directly. The Act authorized the CFPB to create this rule, also implemented under TILA, Regulation Z, and it's all about eliminating conflicts of interest that were, frankly, rampant before the crisis.
What kind of conflicts?
Before this rule, it wasn't uncommon for MLOs to be paid higher commissions for originating loans with less favorable terms for the borrower. Things like loans with prepayment penalties, balloon payments, or simply loans with higher interest rates or points than the borrower might have truly qualified for. This created a clear conflict of interest, incentivizing the MLO to steer the borrower into a more expensive loan because it meant a bigger paycheck for the MLO, even if it wasn't in the borrower's best interest.
That sounds terrible.
It was a major problem. The LO comp rule was a direct response to this practice. This rule prohibits compensation practices that create incentives for MLOs to steer consumers into loans with higher interest rates or other unfavorable terms.
How does it prohibit it?
It specifically bans compensation based on the terms of a loan. The only permissible basis for varying LO compensation is generally the loan amount itself. So an MLO can be paid more for originating a larger loan, that's okay. But they cannot be paid more for getting the borrower into a loan with a higher interest rate, a longer-term specific points, or features like prepayment penalties. That crucial prohibition realigns MLO incentives with the borrower's interest in getting appropriate, affordable terms.
So no incentive to upsell on rate or risky features.
Exactly. And the rule also prohibits dual compensation.
Dual compensation, what's that?
This means an MLO generally cannot be compensated by both the consumer, for example, through borrower-paid points or fees designated as LO compensation, and another party, like the creditor or mortgage broker, for example, through yield spread premium or commission from the lender, in the same transaction. They have to pick one source of compensation for that specific loan.
Can't get paid by both sides.
Generally, no. This prevents scenarios where the MLO might steer a borrower towards a lender offering the MLO a higher kickback, even if that lender isn't the best option for the borrower. It promotes transparency and ensures the MLO's loyalty is clearly defined. You must understand LO comp prohibits pay based on loan terms other than amount and prohibits dual compensation.
So no steering based on compensation tied to terms, and no dual compensation from different parties in the same deal. Protecting the borrower from conflicted interests and ensuring MLOs are compensated fairly without incentivizing predatory practices. That transparency around compensation seems critical for building trust.
Absolutely. No low comp, no, it came from Dodd-Frank.
Okay, ATRQM, LO comp, what else?
And finally, a huge one for disclosures that MLOs work with every day, the TILA-RESPA Integrated Disclosure, TRI-D rule.
Try loan estimate and closing disclosure.
Exactly. Dodd-Frank directed the CFPB to integrate the overlapping mortgage disclosures required under the Truth in Lending Act, TIA, and the Real Estate Settlement Procedures Act, RESPA. Before tried, borrowers received a confusing stack of documents, the Good Faith Estimate, GFE, from RESPA, the initial Truth in Lending, TIL, statement from TILA, then later the HUD-1 settlement statement from RESPA, and the final TIL. Often the numbers didn't quite match. The formats were different. It was very hard for consumers to compare loan offers or understand their final closing costs.
I remember hearing about that confusion.
It was significant. So the TRI-D rule, implemented by the CFPB primarily under Regulation Z, TIA, but incorporating RESPA elements, replaced those four forms with just two main ones. It replaced the old GFE and initial TIL with the combined loan estimate, LE, which must be given to consumers shortly after application.
The LE standardized format, easier to compare offers.
That's the goal. And it replaced the old HUD-1 and final TL with the closing disclosure, CD, which must be provided to the consumer at least 3 business days before closing.
To CD, know before you owe.
Exactly. This integration was designed to make disclosures clearer, more consistent, and easier for consumers to understand the costs and terms of their loans before they get to the closing table. The goal was to provide know before you owe transparency and allow for meaningful comparison shopping. You must know that TRI-D with the LE and CD was mandated by Dodd-Frank.
LE and CD, the cornerstone disclosures of modern mortgage lending, designed to improve consumer understanding, all directly mandated by Dodd-Frank. These are documents you'll be working with constantly as an MLO, so understanding their origin and purpose via Dodd-Frank is absolutely key. It really simplified a very complex part of the process for consumers.
It aimed to, yes. So those three, ATRQM, LOCOMP, and TRI-D, are major rulemaking stemming directly from Dodd-Frank that fundamentally changed mortgage origination.
Got it. ATRQM, LOCOMP, TRI-D, all Dodd-Frank babies, essentially.
You could put it that way, yes. Now, beyond these major rules, Dodd-Frank also placed significant restrictions on certain loan terms that were common before the financial crisis, particularly within the qualified mortgage QM framework we discussed.
Like what kind of terms?
Features such as prepayment penalties and negative amortization. Prepayment penalties, which charge borrowers a fee if they pay off their loan early, like during a refinance, were severely restricted or prohibited on most QM loans. This prevents borrowers from being trapped in a loan, making it costly for them to refinance into better terms if rates drop or their situation improves.
Makes sense. More flexibility for the borrower.
And negative amortization, where the loan balance actually grows over time even if the borrower makes their scheduled payments because the payment isn't enough to cover the interest due, was generally prohibited for QMs. This was a direct response to practices that contributed to the crisis by creating unsustainable payment shock loan products for many borrowers. Dodd-Frank aimed to curb these riskiest features.
So, curbing some of the riskiest loan features like prepayment penalties and negative amortization to protect consumers and prevent them from getting into unmanageable financial situations. It sounds like Dodd-Frank really tightened up what was allowed in the market, especially for standard QM loans.
It did. It significantly reshaped the types of loan products commonly offered.
Okay. Any specific Dodd-Frank timelines we need to memorize like we did for HPA?
That's a good question. A final note on Dodd-Frank timelines. As a broad, overarching legislative framework, Dodd-Frank itself does not have its own specific, direct timelines for things like mortgage origination disclosures or record retention that you'd find in a specific rule like TUR-ID.
Ah, okay. So the timelines are in the rules created by Dodd-Frank, not the act itself.
Precisely. Any operational timelines associated with Dodd-Frank's mandates are found within the specific rules it authorized and empowered the CFPB to create. For example, you'll find the strict timing requirements for delivering the loan estimate and closing disclosure, waiting periods, and record retention requirements within the TUR-ID rule itself. You'll find record retention requirements for LO compensation within the LO comp rule. Dodd-Frank sets the stage and mandates the rules, and those individual rules carry the specific timing requirements for day-to-day MLO operations.
So Dodd-Frank sets the stage and authorizes the rules, and those individual rules carry the specific timing requirements. You'll find the deadlines for disclosures, for example, within TRIDE itself, not directly in the Dodd-Frank Act. It's the blueprint, not the instruction manual for every single screw. Makes sense.
That's a good way to think about it.
Hmm.
Dodd-Frank provided the mandate and the authority, primarily through the CFPB, to write those detailed instruction manuals.
Wow. What an incredible deep dive into some of the most critical acts you'll encounter on the safety exam. It's crystal clear that mastering these details, the specific percentages like 80% and 78% for HPA, the education hours like 20 for PE and 8 for CE under SAFE, the loan volume thresholds like 25 or 200 for HMDA, the timelines, the distinct conditions, the definitions like original value or QM, and the distinctions between regulations like G and H is absolutely key to securing that perfect score.
Indeed. We've covered a lot of ground, and the precision matters. The HPA, with its precise PMI cancellation thresholds and conditions, remember 80% request versus 78% automatic versus midpoint final, and the specific conditions for each. The meticulous SAFE Act requirements for licensing, the detailed 332 PE and 322 CE hour breakdowns, those crucial 30-day and 6-month retake rules, and the 7-year versus at any time felony look-back periods that speak to industry integrity. Then HMDA's vital data collection purposes, community needs, anti-discrimination, public investment at specific asset size, and the critical loan volume thresholds, 25 closed end or 200 open end each of 2 years. And their frequently tested visual observation rule for face-to-face apps.
Yeah.
And of course, the foundational impact of Dodd-Frank, creating the powerful CFPB and authorizing those foundational rules like ATR-QM, LU-Comp, and TRIDE that shape daily practice. These are not just isolated facts to cram. They represent the bedrock of responsible, compliant, and ethical mortgage lending today. Your ability to recall these details, including the exact figures, timeframes, and precise conditions, will be paramount for exam success. Every single specific number and nuanced condition we highlighted today is a potential exam question designed to test that deep understanding.
So what does this all mean for you, the listener, as you continue to prepare for that perfect score and your future career as an MLO? You've got the roadmap, the key facts are highlighted, and now it's about drilling down on these precise details through study and practice.
And perhaps this raises a more profound question beyond just passing the test. How will your thorough understanding of these interconnected regulations, from empowering borrowers financially through HPA to ensuring industry integrity and your own professionalism via SAFE and Dodd-Frank's rules, and promoting fairness and equity through HMDA's transparency, how will this deep knowledge not only help you ace an exam, but genuinely empower you to serve and protect future homeowners effectively and ethically throughout your professional journey? It's about building trust, demonstrating competence, and truly making a positive difference in a complex but vital industry, recognizing the bigger picture and the why behind all these rules beyond just memorization for a test.
A powerful thought to leave you with as you continue your journey to becoming not just a licensed MLO, but a top-tier, knowledgeable, and ethical one. Until next time, keep digging deeper.